In this week's video, we'll review the latest charts to help us answer the question, is information overload killing your investment returns? We've got a lot to cover this week, so we're going to be moving extremely quickly. Dow Transports, January 2018, correction, subsequently go on to make a new all-time high. The industrials confirming that move on September 20th, 2018, a correction, subsequently went on to print a new all-time high. All things being equal, this is a positive development and can be added to the weight of the evidence. Watching the markets too closely and paying too close attention to the present-day headlines is nothing particularly new in the investment landscape. However, in the present day, with cell phones and laptops and access to information 24/7, scary headlines can lead to overtrading and poor performance. S&P 500 daily, roughly April 1st. Here, on April 2nd, Dow drops 459 points. Trade war fears rise. May 3rd, 2018, get ready to lose a trade war. May 17th, 2018, it will be challenging for the United States and China to reach an agreement at trade talks. June 28th, 2018, 100,000 Americans could have their jobs destroyed by Trump's trade war. August 2nd, 2018, trade war slams stock markets again. September 7th, 2018, another nerve-rattling headline. Trump threatens tariffs on all imports from China, escalating trade feud. Our purpose here is not to criticize the media. We have to understand what business they're in. They're ultimately in the eyeball, clicks, and advertising business. They don't wake up every day, gather in the newsroom and say, what stories can we produce today that will help investors navigate from point A to point B? That's not their job. If we were checking our phone every 13 seconds and watching the market tick by tick, it would be very, very easy to start to believe that the trade war was not only going to upend the stock market, but a recession has to be close at hand. Despite all of these scary headlines between point A and point B, the S&P 500 gained 14.77%. And not surprisingly, there was a tremendous amount of volatility between point A and point B. When we all wake up every day, we only have so much mental energy, and we need to be very, very careful as investors and traders to use that energy wisely. It's very, very easy to chew up a lot of valuable emotional and mental energy on these scary headlines. Under our approach, if any of this is relevant or becomes relevant, we know with 100% certainty it has to start showing up in the weight of the evidence on multiple time frames. If we were just reading the newspaper and watching TV, we might believe that China is absolutely killing the United States in this trade war. And that may or may not be the case. But what's important for us is what's happening in the markets from a factual perspective. So despite all of this, year to date, the market's take on the weight of the evidence, which includes the trade war, is very, very positive for the United States. The strongest market, United States, followed by the UK, Germany, Asia ex-Japan, and China. This total return from December 29th, 2017 which was the last trading day of 2017, up to the close on September 20th, 2018. The delta between the United States and China is roughly 20% year to date. Now we're going to link back to our simple 100-day moving average in blue all the way out to the 290-day moving average. These are generic moving averages to illustrate basic concepts about trends, which is another way of saying we are not using these moving averages to make timing decisions. We do, however, use similar concepts to make timing and allocation decisions. .com peaking process. The left side of this chart here looks quite a bit different than the right side of the chart. Similar situation for the peaking process in 2007, 2008. On the left side of the screen, blue, the fastest moving average, is on top, and the slopes of all of the moving averages are positive. This is our full-bore bullish look. Here, it's our full-bore bearish look. Blue, the fastest moving average on the bottom. The slopes are all down. This really doesn't look anything like this. And this transition is the type of look that we want to avoid. And in here somewhere is where we're shifting from volatility to ignore to volatility to respect. Volatility to ignore, volatility to respect. From a generic concept perspective. So in simple terms, the left side of these charts, we have a bullish bias, and on the right side of the charts, a bearish bias. If you know your market history, you know the peaking process took a long time in the year 2000, and the stock market really didn't roll over in a violent manner until the end of the year 2000. We've also been moving sideways for a long time in 2018. How does the exact same chart look today? Does it have a bullish bias, or is it morphing into something with a bearish bias? The answer is relatively simple. September 20th, 2018, price makes a new high here. This looks like a successful retest, and now we've gone on to make a higher high. Keep in mind, we've covered these charts numerous times in the past, including in a video in August of 2017, where we define the bullish bias and the bearish bias. There's absolutely no question based on those generic definitions and concepts that the present-day chart on September 20th, 2018 has a bullish bias, which speaks to probabilities. The probability of good things happening relative to the probability of bad things happening remains favorable on September 20th, 2018. And why this type of look here is important. We can see this, measure it, and put it in a model when the S&P 500 was still trading at 1430 late in calendar year 2000. We can see all of this, measure it, and put it in a model late in calendar year 2007 when the S&P 500 is still trading at 1500. No forecasting or predicting is necessary. And that information turned out in these cases to be extremely helpful. Because after we could see all of that, really bad things happened. In this case, the S&P 500 dropped from 1430 to 768. And in this case, we went from 1500 to the day-mean low of 666, which equates to an additional loss from this point here of 46% and an additional loss from this point here of 56%. And we've just shown that the present day really doesn't look anything like this, nor does it look anything like this. How does the present day compare to these periods? A favorable look here in 1996 and a favorable look here in calendar year 2013. there's no question that the present day looks a lot more like this period here that was followed by an additional gain of 156%, and it looks a lot more like this period here that was followed by an additional gain of 26%. Once again, speaking to nothing more than probabilities. As we've covered numerous times, including in August of 2017, before any of these scary headlines appeared in 2018, and before this waterfall plunge and subsequent very, very difficult to trade rally off of the low. With the benefit of hindsight, why does all of this appear to be so easy? Because when we look at the historical charts, it strips out all of these difficult things that get us sidetracked when we're watching markets in real time and reading stories, scary stories, day after day after day. In short, when we look at this chart years down the road, the historical chart strips all of this out, which means when we're looking at these in 2018, our money's not on the line, our ego has nothing to do with any of this, our emotions aren't in play, we don't have to deal with any of the psychology related to the markets, we don't have to master ourselves or be disciplined to understand what this is telling us, and we don't have to deal with any of the concerns that were present here in 1996. It wasn't easy here, and it wasn't easy here. It only appears easy when we look at it in the rearview mirror because of all of this. 2018, day by day, has been difficult, despite the fact that the chart still looks relatively easy. Because as we walked through it day by day, all of this was back in the equation. Money, ego, emotions, psychology, and mastery of self. And even now, with the benefit of hindsight, this looks relatively easy. But if you've been trading your own account or managing your own money, you know it hasn't been easy. And we didn't edit these charts here purposely, because it helps us show that we originally covered them in August of 2017. We talked about all of this before any of this occurred. And when we go back and review what we covered in August of 2017 and review what's happened year to date, it helps us understand the importance of trying to avoid these common missteps, most of which center around the following: watching the markets too closely, worrying about what everyone else is doing, worrying about what everyone else is saying, having a short-term focus and short-term fear. Human beings on a daily basis, and especially when our money is involved and our egos are involved, constantly have to battle numerous forms of bias. And as we covered back in August of 2017, there is always, without exception, something to worry about. Geopolitical events, fundamentals, technicals, what-if scenarios. We could make a list of scary things every single week of the year, regardless of the market's current profile. We could make a scary list of things, regardless of the market's profile and regardless of how strong the long-term trends have remained throughout all of this. And when we make that scary list or start checking off these common misstep boxes, all of that greatly increases the odds of falling prey to overtrading and subsequently disappointing performance. Think about price action in 2018. Then think about price action within the context of the facts that we had in hand here, 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 and here. And then think about this quote that we have covered numerous times, including numerous times before we flip the calendar over to 2018. Question. In other words, in order to score really large gains, you have to be willing to see those gains erode significantly before getting out of the market. Answer from the market wizard. I can't see any other way. If you get too careful about not risking your gains, you're not going to be able to extract a large profit. If we're trying to capture a very, very satisfying gain that could occur between a point A and a point B that could be several years down the road, it's mathematically impossible to ever capture a 375% gain in the stock market if we keep locking in 2% gains or 2% losses. And as we covered in last week's video, we are not, under our approach, and everything we talk about in these videos relates to our approach. Yours may vary. Under our approach, we are not advocating blind buy and hold. Our task is to try to differentiate using hard data between volatility to ignore and volatility to respect. Volatility to ignore and volatility to respect. Thus far, based on the weight of the evidence, not this one moving average here, the weight of the evidence, for the most part, and clients know this, based on the low portfolio turnover year to date, the model has classified basically all of this as volatility to ignore. Why? Because the hard data that we had in hand down here told us that the probability of this being a normal correction within the context of an ongoing uptrend was favorable. And that was simply probabilities. And we know when we play odds, sometimes you play favorable odds and it works out. Sometimes you execute perfectly and play favorable odds, and the lower probability outcome occurs. That's why we have to head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.